The simple way to put it, it's just the limit on the amount of money that the U.S. is allowed to borrow to fund the government and meet its financial obligations, including things like interest payments on debt. So if you want to think of it from a personal finance perspective, it's almost like your credit limit on a credit card. So that's the most money you can borrow, and also you have to pay interest on what you borrow.
You're listening to IBKR's Census Security. Find more conversations at ibkrpodcast.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome back to the Sons of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers. Today, I'm your host for our podcast, and our guest is Michael Normyle, Senior Director of Economic Research at Nasdaq. The U.S. debt ceiling, or the debt limit, is a popular topic when it comes to government spending. Although it is not just important to Americans, it can impact the broader markets, and investors can also see its effects. In today's episode, we're going to discuss the basics of the debt ceiling. Welcome to the program, Michael.
Thanks for having me.
Sure. So since this is your first time on this podcast, we generally have a little bit more of a intro to finance audience or a beginner audience, new to the scene, if you will. So what exactly is your background in the industry and how'd you get to where you are?
Sure. So I've been working on the economic research team at Nasdaq for about 2.5 years now. So my day-to-day is generally focused on U.S. macroeconomics. Of course, the debt ceiling, comes into play there every so often when it's up for being changed. I do spend some time on equity market microstructure research as well. Prior to that, I spent 10 years working in macro forecasting at the Economic Cycle Research Institute, where the primary focus was forecasting business cycles and inflation cycles for the 22 largest economies in the world.
So you seem pretty well-rounded for this conversation.
Hopefully, yeah.
Yeah, so to kick it off, the debt ceiling or the debt limit, usually that's something that comes up a lot in conversation about the U.S. government and maybe if people are talking about bonds. But how exactly would you describe the debt ceiling to somebody just learning finance?
The simple way to put it, it's just the limit on the amount of money that the U.S. is allowed to borrow to fund the government and meet its financial obligations, including things like interest payments on debt. So if you want to think of it from a personal finance perspective, it's almost like your credit limit on a credit card. So that's the most money you can borrow. And also you have to pay interest on what you borrow. You can request to increase your credit limit. So all those things have kind of analogous relationships to the debt ceiling. Unlike the federal government, though, you can't print money to pay off your credit cards, unfortunately. So that's the one big difference.
Right. So obviously we're talking about this in the broader scheme of the country of the United States. But from what my research and has been raised or held at different times to hope to avoid default for the country. And then another piece that kind of comes in, which we'll talk about a little bit later, is kind of the government shutdown area. But when it comes to the actual idea of this ceiling or this limit, why is it in place if, like you said, there's just a way to put more money into the system? Why have it there if there's a way out? You know what I mean?
Yeah, I think that's a good question. And honestly, you could argue that having a debt ceiling causes more problems than it solves in a sense. The U.S. is relatively unique in having a debt ceiling that requires congressional approval to change it. In other countries that do have debt ceilings, they can be automatically increased or they're done in a routine manner. For the U.S., though, we have a debt ceiling because the U.S. government typically runs deficits, meaning it spends more money than it takes in. And so it needs to borrow money by issuing debt like treasury bonds to fund the gap between what it spends and what it takes in. And so this puts a limit on how much the government can borrow. So, you can't just have unlimited spending from the government. This kind of prevents something like that from happening.
Who exactly are they borrowing from?
It can be really anybody, right? The mom and pops can buy treasury bonds, or it can be hedge funds or investment banks, whomever. So it's, not just people in the U.S. too. There's an international market for U.S. treasury bonds. So there's a lot of people outside the country. Of course, the U.S. government, our credit is very highly rated. And a lot of people think, as the biggest economy in the world, it's very unlikely that the debt will be defaulted on. So it's a very safe investment, it's considered. The debt ceiling, it dates back to World War I. And prior to that, Congress had authorized each instance of debt issuance from the Treasury But to give the Treasury more flexibility in managing federal finances, the Second Liberty Bond Act of 1917 was passed. And then by 1939, the debt ceiling that we starts to look more like we have today, where multiple limits were consolidated into a single borrowing cap.
So you mentioned limits in there. It would seem like we have a cap on how much the country could borrow, but could that debt ceiling rise? Because that was a popular topic this summer about raising the debt ceiling or the debt limit. Could it rise, and how exactly does that happen?
Yeah, so there's really three options. It can be raised, it can be suspended, and it can actually be lowered. In fact, at the end of World War II, it was actually lowered. But in recent decades, where the government regularly runs deficits, the debt ceiling generally needs to be increased occasionally as the outstanding debt approaches the current ceiling. And so if Congress can't agree on a specific number, that's when they can suspend it. When it's suspended, the government can issue debt without a cap. And then when the ceiling eventually is reinstated, it's increased above the current amount of debt. To increase the debt ceiling, though, it takes congressional approval. And since 1960, they've increased the debt ceiling nearly 80 times. So it's a regular occurrence. But for most of the history, Congress has increased the debt ceiling as a matter of course. Since 2011, though, we've had a few instances where it's become a bit politicized. In August 2011, Congress only increased the debt ceiling just days before the government would have run out of money, and that date is known as the X date. And that led to the S&P credit rating business downgrading U.S. credit from AAA to AA plus and referencing political brinksmanship as a reason there. We saw similar situations in 2013, 2021, and 2023 when the debt ceiling was suspended in June through the end of this year. And it was extended through the end of this year on purpose to be after the next presidential election. But that 2023 experience also saw another credit rating agency, Fitch, downgrade the U.S. credit rating to AA plus from AAA.
So, without getting political at all here, from a strictly economic perspective, what is the pros and cons to raising it?
It's just that we need to, because we run these deficits, there's certainly good reasons to run deficits as a government if you're making investments in infrastructure and things like that. For example, these things, they're very big upfront costs, but they pay off for the economy over the coming years and decades. And it can pay off in higher GDP growth through increased productivity. If you're, for example, going from having no kind of highway system to building a nationwide highway system, that really helped with transporting goods around the country, those types of things. So it's necessary oftentimes to run a deficit. Also, if the government were to go from running a deficit to not running a deficit, it would either need to be through increased tax or cutting spending dramatically, which would negatively impact GDP, probably costing people a lot of jobs. So there's a lot of reasons to run a deficit. And in doing so, you need to borrow money and you need that debt ceiling in place.
Got it. So when we're talking about this government, say, I don't want to say control, but kind of the government's deficit here for the US at least, this debt ceiling or debt limit is impacting a whole lot. It's more than just the people in office not getting along. It's also government programs and other types of spending and other types of money flow throughout the country, and then potentially other countries who do business with us. So how does the debt ceiling correlate to the government operating and a potential government shutdown?
Well, so the debt ceiling and government shutdowns are kind of two separate things. The debt ceiling is a limit on how much the government can borrow. A government shutdown happens when the money to fund the government hasn't been appropriated by Congress, even if the debt ceiling has enough money to provide that funding. Congress has to pass new legislation each fiscal year to fund the government. If they can't agree on a full year funding bill, we can see non-essential parts of the government shut down, including furloughing of employees of those agencies. Alternatively, Congress can pass stopgap funding bills called continuing resolutions or CRs that fund the government for as little as one day, but often weeks or months to give Congress time to negotiate on a bill to fund the government for the rest of the year.
So how would investors start to see their day-to-day life, country, investments, portfolio get impacted if the country gets close to this debt ceiling, or as you mentioned, there was like the possible suspension or what have you. How exactly would the day-to-day investor see this impact?
Well, if investors in general are confident that the debt ceiling is going to be raised without much of an issue, it honestly doesn't have much impact on markets. The potential impacts happen when investors start to price in a chance that the government reaches the debt limit. And like I said earlier, there were 4 recent times when that happened, where people were at least a little bit concerned that a debt ceiling standoff could result in a default. So that was 2011, 2013, 2021, and 2023. And so the concern stems from the risk that the government defaults on its debt. And if that happens, then the US will become a much riskier borrower. So earlier I was talking about people internationally pay for US Treasury bonds because the US is seen as such a low risk borrower. But if we do default on our debt, then that changes. And so people expect that if the government were to default, we'd have to pay higher rates on future debt, given that increased credit risk. And so beyond that, it would also be problematic for the economy. During the 2023 standoff, Moody's estimated that just a weeks-long breach of the debt ceiling would cause an almost immediate and severe recession, resulting in 7 million jobs lost and a nearly 20% drop in equity prices. And that's because no longer able to spend more money than it takes in, the government would have to slash its spending immediately, cutting about $350 billion in deficit spending and furloughing government workers without pay. So looking at how markets reacted to the debt ceiling issues in the last 13 years, the most consistent impact we see is on short-term treasuries. And so yields on short-term treasuries rise sharply in the days and weeks ahead of the X date, or the date when people expect that we would potentially run out of money, because those are the treasuries most at risk of defaulting, since they would potentially mature during the time when the government hit its debt limit and can't repay those lenders. So to compensate borrowers for this higher risk, we see higher interest rates on those short-term treasuries. But then once the debt ceiling is resolved, they quickly revert to normal yields. Long-term yields are generally unaffected, though, since they're not really at risk of default related to the debt ceiling. And then for stocks, we did see sell-offs ahead of the 2011, 2013, and 2021 X dates due to uncertainty caused by the debt ceiling standoff. Once the debt ceiling was resolved, stocks rose again, except in 2011, where that S&P downgrade I talked about earlier of the U.S. credit rating continued the sell-off a little bit.
Just completely hypothetical here. If the U.S. was to default on these debts or bonds, what are like some bullet points that would happen?
Well, I guess in a sense, it's kind of hard to predict because it's never happened before. But I think the short-term issues is that the U.S. would have to pay higher interest rates on its debt, which is a problem because we already have a significant government debt load and it's projected to keep rising. So we've recently past the point where government expenditures on net interest is the third largest expenditure after Social Security and Medicare. So seeing money that's being just spent on interest, you can consider it almost as unproductive money being spent, really, because if we didn't owe that interest, then all those billions of dollars could be spent on, like we talked about earlier, building highways, building tunnels, whatever. So we would be dedicating more and more money to kind of unproductive things, essentially. So I think the risk that you have is that you have a higher interest rate that you're borrowing at, and that puts a headwind on long-term growth. So it could ultimately reduce kind of the economic trajectory of the U.S. economy. So really best avoided.
I mean, right. It makes sense. You don't want to see any government defaults on any of their debt or loans. But from the perspective of purely education, just to show the ripple effects, that's kind of why I bring that up. I mean, not to look for a headline too much, but it's only so American that America has so much debt. Just like all of its citizens, America has so much debt. So it makes sense.
Right.
Yeah, so thanks for joining us today, Michael.
I really appreciate it. Thanks for having me.
Sure. So as always, listeners can learn more about an array of financial topics for free at IBKRcampus.com. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everybody.
Thanks for listening to IBKR's Sense of Security. As always, there's more content at IBKRpodcast.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education content such as webinars, market commentary, market-related courses, and quant-related articles at ibkrcampus.com.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.